Let me bring on board actually the sector of the hour to discuss that. Shweta Daptardar, Vice President at Vice President of or tracking BFSI at Elara Securities. Shweta, good having you here. I want to first start off by asking you, what does this crackdown actually mean for the MFI sector? Does it mean that the pain is yet to come? What is your assessment of what RBI is saying?
Yeah, good morning. So the pain is already there. It's been around for a while now.
Yes.
And like we have been mentioning, last 7 to 8 years, the sector which has grown phenomenally higher has been MFI and MSME sector. Now, yesterday's strong action that comes from RBI as against few NBFCs with regards to non-compliance of certain norms, especially in the microfinance business and also gold lending, is going to hit definitely harder. So the entities in question, especially from the listed side, is Ashirvad Micro Finance, which is subsidiary of Manappuram Finance, is definitely going to be hit harder. We are seeing downgrades on the EPS front. So that is definitely going to have a negative rub-off effect across NBFCs.
Okay. No, so point taken. I want to try and focus in because you've brought it up, Ashirvad. It's around 25% of Manappuram's book. What are your estimates now hinting at? What's the kind of impact like maybe over the next year at least? Because likely will take 6 to 12 months to resolve.
Yes, so any entity coming under RBI radar, as you rightly pointed out, should definitely be under pressure at least for 6 months, and maybe business normalization happens, say, over 12 months time frame. The entity in question definitely, wherein 25% of AUMs of Manappuram is definitely held by a microfinance subsidiary. What is more important is the profitability matrix. So Ashirvad forms over 21% of the profits of the parent company and 9% of the parent's net worth. So, given the kind of pressures and now bar on business activities incrementally for Ashirvad would definitely mean over at least 20% earnings cut for the parent company. So, outlook definitely remains gloomy. We also see this spreading across the gold lending business activities of the entity in question.
And it pushes listing too, right? So value unlocking also getting pushed. They filed their DRHP. That is further accentuating the pain.
Very much. So if you see the turn of events, it was in 2023 October, exactly a year ago, wherein Ashirvad had filed for IPO, and then the chain of events have been little volatile. So in January there was an abeyance that was put on the company for IPO listing. Then April was the good news, wherein SEBI cleared the listing sort of process, and now October, that is yesterday, we saw this coming, with respect to non-adherence to guidelines. So it's been a roller coaster. But what largely it hints at is definitely the subsidiary would be now looking for money or funding from the parent. So that definitely is an offering, to get back operationally fully. And given that it's, the leverage is on the higher side, capital raising or infusion from the parent entity is definitely an offering.
Yeah, so I agree with you, but 20% was their capital adequacy, if I recall right. Please give us perspective on that. And you will
Yeah.
also see loan repayments getting front-ended, right? Or rather, maybe not front-ended, but there won't be any loan disbursements, and therefore loan repayments will actually shore up capital at Asirvad. So just give us perspective on why the capital raise.
Yeah. So two things here, more than loan repayments, see, look, we have to also see from the perspective of the headwinds in the sector. So if you look at the collection efficiencies, if you look at recoveries, they have been abysmally lower quarter-on-quarter basis. We know already the business update numbers from the top player in the market who has already reported over 200 bips decline in collection efficiency. So somewhere the collections and repayments have got delayed and impacted. So regardless of whether repayments come timely or not, raising or funding requirement is definitely an offering. The reason being, now that, as you also rightly pointed out, now that the business activity comes to standstill, going forward, the current operational metrics will require a support, and that's where we see the some funding coming from the parent company.
And we've seen this at least over the last couple of quarters. You had someone like a Fusion Microfinance also, pre-warn investors that this time's results, they're going to have a knock of around 500 crore in terms of provisioning. And that's a large quantum for, for the size that Fusion is. We're seeing that in credit access as well. Growth has slowed down. Spandana as well. Just talk to us about how long do you believe this cycle is going to last? Because growth is clearly slowing down visibly. Processes are getting revisited. And it's a very small pocket of the market. And therefore, everything else currently remains a blue sky.
Yeah. So one is the sector is definitely under stringent radar of the regulator. So there is regulatory forbearance, which will definitely lead to recalibration of loan growth for the entire MFI space per se. Second, the main concern or the prime concern, which stems from the fact that there has been over leveraging at the borrower base. So the number of loans per borrower has been rising higher since couple of years. So these are the biggest concerns which RBI is trying to address, and that's where you will see calibration on the loan side. Second, and which RBI highlighted even in yesterday's press release, was the usurious rates or mispricing of assets. So there has been higher interest rates that have been charged. Spreads have been higher over and above the cost of funds. So that is another reason which has been impacting the earnings of these MFIs, wherein now margins will come under pressure. And third, and the most important point which you pointed out, is the increased provisioning requirements. So while the headwinds have been scattered across geography, so there are geography-led challenges, then there are structural challenges, like I mentioned, in terms of over-leveraging of borrower base. So that put together, your credit cost is definitely looking higher. So net-net, your earnings remain under deep pressure for the entire space. So in my sense, in our assessment at Elara, at least for 2 quarters, we say it's a complete, MFI is a complete go-by.
So that's Q2, Q3 or Q3, Q4?
Q3, Q4.
Okay, got
clearly.
it. Got it. And, these are times when, you can clearly and visibly separate the men from the boys in terms of processes, in terms of asset quality, just kind of reflective. Which ones do you believe will stand out and therefore command a premium valuation maybe 1 to 2 quarters out?
Yeah. See, we are coming from the fact that the valuations have been lofty for NBFCs for a while now. With rate cut expectations also still away, and maybe perhaps 25 to 50 bips of rate cut by the end of this year definitely do not suffice for margin improvement, especially where your bank borrowings have become dearer due to RBI increased risk weightages norms. So we are coming from a scenario where valuations have been lofty. Now regulatory forbearance comes into picture. Outlook is gloomy as far as the whole space is concerned. So net going forward, we do not see much of outliers, at least in the MFI space. As far as the whole space of non-banking financial services is concerned, cherry picking is the key. So we would go by strong balance sheets, higher liquidity ratios, and the ones with stable asset quality. And if I were to list, there are very few names who fits the bill. So for now, the sector looks gloomy per se.
Gloomy for now. Okay, thank you so much, Shweta. It's good having that context. And of course, Manappuram reeling under pressure. So thanks for that viewpoint.